Welcome to the TMRN, Time Monk Radio Network. I'm McLaren, and today's date is the 23rd of April, 2011. Joining us this evening from Niceville, Florida is Mr. Karl Denninger. Welcome to the WebBot Forum Roundtable.
Thank you.
The WebBot Forum administrator is Fox, and today he will be doing the recording and technical support of the show. Several forum members were kind enough to join us tonight. They include Mulder, Thor, Giuseppe, Mizar, Groundrod, and, of course, I am McLaren. For listeners, this interview, we will assume you have a fairly good understanding of Karl's work, as well as keeping up on the financial markets and economy by reading sites such as Mish's Global Economic Trend Analysis, Calculated Risk, Naked Capitalism, Zero Hedge, and, of course, the market ticker at www.market-ticker.org. This interview will be available on YouTube for free, on the WebBot Forum channel, and linked to webbotforum.com. Karl, are you ready to go, sir?
Most certainly. Let's have at it.
Terrific. Karl, before we get to the economics and financial questions, we'd like to ask you if you've heard of the WebBot project and Cliff High. If so, what are your thoughts on the ALTA and or the Shape of Things to Come reports, and the premise that all human beings are prescient and that future events are leaked out through the collective?
Well, I think most of us have had some kind of a deja vu or premonition kind of event in our life. So the premise that there is some kind of mass collectiveness, if you will, is not at all unreasonable. I'm somewhat of a skeptic as to whether or not it shows up in the writings of people ahead of time, to be honest, and I am aware of your work. There have been some spectacular hits, and then there have been some spectacular not quite so hits. But I guess that's the nature of such things. You wake up in the middle of the night with some kind of a dream that's going on, and if you write it down, something may happen and it connects to you later, but it may not be exactly in the form and the fashion that you saw. So I think there's something to it. I just don't know how to assign a probability to it.
It certainly is a difficult thing to do, and we're impressed that Cliff has been as on target as he has been. Thank you very much, Karl. To help listeners who may be unfamiliar with your views on economics and finance to understand your views of what's going on in these realms, it would be helpful if you would inform them of your definitions of certain terms. Among these are inflation, deflation, and so-called biflation. If you would please start with these.
Sure. Inflation is, if you look at it in the form that is used by the mainstream press, it is a generalized rise in the price level of all things across the economy. Deflation would be the opposite. And biflation would, of course, be the generalized rise of certain things and the decrease in prices of others. If you take a monetarist's view, a more pure economist's kind of view that you'll have with PhDs sitting around the table, inflation is first and always a monetary phenomenon. But I take some exception to the premise that many people have that it is simply the amount of currency or base money, if you will, that is in an economy. My position has always been that you must look at both money and credit in an aggregate, and the reason for that is if you pull your wallet out and you take a look at it right now, you probably have some dollar bills in there of various denominations, and then you likely also have a couple of credit cards. And your credit card spends exactly as does your money. So you have to look at the available credit that is available in the system as well as base money in order to determine from a monetarist's perspective whether or not there is inflation or deflation occurring.
Okay, thank you very much. Our first question this evening is going to come from Mulder. Mulder?
Hi, Karl. My question is why is it that you don't seem to believe that QE has the potential to be a hyperinflationary force?
Well, that primarily goes to what I was just discussing, which is that you have to look from a perspective in inflation or deflation. You have to add up the sum total of both money and available credit. And the important factor there is it's not just the credit that's outstanding. Right now that stands at about $53 trillion. you also have to look at the amount of available credit that people have to borrow with and whether or not that amount is going up or down. If you have a credit card in your wallet and it's maxed out, it is worth nothing. On the other hand, if you have $10,000 worth of available line on it, then it is just as if you had $10,000. You could spend it all right now at this instant. QE, as a hyperinflation trigger, if you will, simply is not of sufficient size in order to have that kind of impact. You're talking about, in the case of QE2, a $600 billion program. There are a number of coiled spring kind of problems with the QE2 program, but they are not of the classical type of hyperinflationary trigger that people would look for. And I think the error people make in that area is that they're looking at the monetary base simply as base money. They're not looking at the credit system, and I believe that that's a serious error, and it leads to bad conclusions.
Okay, so can you describe how quantitative easing differs from monetization, and if it does, how does it differ?
Doesn't differ at all. It's the difference between monetization of government debt. I mean, we have to differentiate between QE1 and QE2. QE1 was essentially the monetization of Fannie and Freddie paper for the most part. Only $300 billion of it was treasuries. The vast majority of it was agency debt. The QE2 program, on the other hand, is entirely treasuries. And so essentially what you have is the Federal Reserve holding down the cost of government deficit spending, which should be much more expensive in terms of the interest rate charge than it currently is. And as a result of their interference in the market, the federal government has been able to run a $1,700 billion deficit over the last 12 calendar months, leading up to the end of 2010. That's a crazy amount of money to be spending beyond what you take in. It's about 43 cents of every dollar that the government spends is being borrowed. And effectively what's happening is you're taking the $600 billion and adding it to the monetary base. The reason it's causing commodity ramps and not hyperinflation is because it's $600 billion and there's a $53 trillion credit base out there. And so in terms of the actual total impact, it's very small, but in terms of the psychological impact, it's huge.
Okay, you may have already answered this one, but I'll ask it anyway. Why is it that you don't think that the destruction of the dollar, which seems to be underway right now, would be hyperinflationary?
Well, the destruction of the dollar would be hyperinflationary. The hyperinflation, by definition, is the revulsion of a currency. And that is when people no longer are willing to hold and trade in a given currency and exit it en masse. That has certainly not happened at this particular point in time. It could happen in the future, but at the present, it's not what's going on. You're seeing a grand fleeing at the speculative level out of dollar-denominated instruments, but at the present time, the Treasury curve is actually quite well behaved. If we were undergoing hyperinflation, we would be having something more similar occurring to what's happened over in Greece with regards to the Treasury yields.
Okay, so what would have to happen for you to reverse your position on the deflation, hyperinflation debate?
I'd have to see a way for the system to take on a hyperinflationary amount of credit, or I would have to see a destruction of the credit system that leaves only base money available, and then for the Federal Reserve to attempt to replace the credit in the system with base money. I don't think there's any realistic possibility of either of those things happening. The collapse of the political and economic system in the United States is hyperinflation in a certain technical view, but it would be more a question of the destruction of the political system rather than the destruction of currency. I don't think the two could, one of them could happen without the other. In others, I don't see the dollar disappearing, but the United States government in its present form surviving. That's a ludicrous proposition under the present set of circumstances. So if we do have an event like that, it's my view that you've got much bigger problems on your hands than what classes of asset you hold.
Okay, thank you, Karl. I have kind of a strange question that just dawned on me. Ben Bernanke, at the beginning of the QE experiment, came on CBS 60 Minutes and admitted as much that they were going to be printing money. And then round 2 of QE came along, another 60 Minutes special brought him back again, and he denied that he was printing money. This was then caught by Jon Stewart on The Daily Show. How can Ben get away with this and CBS get away with this? Is it that the American people really don't understand what the concept of money is?
I think the American people are too busy watching American Idol and Dancing with the Stars. Ben Bernanke has told so many whoppers on Capitol Hill and hasn't been called on them there either. I mean, this is the man that said there was no housing bubble. He then said there was going to be no recession. I mean, I have a whole litany of predictions that were absolutely worthless over the last 4 years that I've made a lot of noise about. He himself has of course said he's really not printing money. On the other hand, you have the president of the Dallas Fed who said yes, they are. You've had other people that have said out loud in the Federal Reserve that yes, this is monetization, this is printing money. So why doesn't anybody call him on it? Where are the journalists? I mean, we had them when Nixon was diddling around in Watergate, but they all seem to have disappeared when the dress showed up with Monica Lewinsky. So I honestly don't know.
Okay. Yeah. No, I just scratch my head. Maybe that's my background, my understanding. But there's a lot more concern about Dancing with the Stars and American Idol than there certainly are about important things like what's going on with the American economy, budgets, all the rest of it. Let me take you back into a little bit of a academic exercise, if I can, please. The great American monetary economist Milton Friedman is quoted as saying, quote, "Inflation is always and everywhere a monetary phenomenon," end quote. In this context, and in your opinion, is the Federal Reserve's policy of targeting or inducing a consumption from wealth effect by supporting asset prices creating bubbles or unsustainable valuations? Beyond a yes or no, if you could please provide us some greater clarity by comparing and contrasting short-term income and employment effects versus mid to long-term income and employment effects in the real economy, and then what other spillover effects might roll out into the so-called financial economy.
Well, Milton Friedman is absolutely correct. As I noted, my only argument with that position in the general sense is I think you have to include credit in the computation. What the Federal Reserve is clearly attempting to do, and Bernanke has admitted this, is that he likes the idea of the stock market going up. The problem with doing that sort of a thing and targeting asset prices is that you go from one bubble to another. What you're really doing is attempting to induce people to take on leverage, that is debt, to support these higher and higher prices. And this is what's happened over the last 30 years. If you take a look at the balance between gross domestic product, the actual output of goods and services in the United States, and the expansion of debt at a total systemic level from all sources, households, financial companies, businesses, state and local government, federal government, you find that by 2007, 1 out of every $3 that were spent in the economy in 2007 were borrowed newly, not produced. Well, that's a problem, and that's the reason we hit the wall, is that if you lose your job and you go home to your wife and you say, hey, honey, I was making $10,000 a month, now I'm making, I got a job down at the corner, now I'm making $6,000, we're going to spend the other $4,000 every month on our credit card. This is a grand scheme that works for a little while, and then eventually you run up against the fact that your minimum payments on your credit card exceed the amount of income that you have, and the game's over. What the government has essentially tried to do is step in and take over that borrowing function, and where Bernanke has blown this, and this has been something I've been consistent on since I started writing about this in 2007, is he has said that this is a short-term stimulative action taken by the Federal Reserve and, of course, in concert with the federal government. But that short-term stimulative action, in order for it to work, would have to return to the ever-declining value of actual output as opposed to new credit in the economy to support GDP. And that hasn't happened. So we're 4 years into this now. The grand experiment has failed consecutively for 4 years. And the only thing that has happened is we have driven speculative hot money flows into things like oil, gold, silver, and stocks. And yet, when you look at the actual underlying amount of money available in the economy, the actual output and production, it's just not there. We have, at this point, we have something like 1 out of every 3 consumptive dollars that are being spent by Americans are coming from federal government transfers. And 43% of everything the federal government spends, it's borrowing. So this is not a sustainable situation, and the alleged shift back to the private economy that was supposed to happen 2 years ago hasn't.
So what we've really got is a shift of wealth and income from the real economy over into the financial economy, and it is only those people truly related to the financial economy that are seeing the beneficial impacts of Ben Bernanke's policies?
Well, I wouldn't even say that it's just the beneficial impacts. There are real negative impacts that are being served up on average Americans. The prudent, reasonable retiree, for example, that has a fairly large chunk of cash saved, that was making out okay off the interest on certificates of deposit, for example, has been forced into dangerous and risky speculative actions in order to get anything at all. There's no interest income available today off of that. A couple of years ago, on a 5% basis, you could have a $50,000 income, federal tax-free, by investing $1 million in municipal debt. This was a reasonable way to live, and a lot of people did this. Now that same sort of investment, if you have it in a certificate of deposit, earns 0.25%, which is $2,500. There's no way you can survive on that. You'll be eating cardboard. So we've taken the hot money flows and put this risk trade into the economy, so to speak. But for those people that are not desiring to risk losing everything they have, this has been an absolute disaster.
Yeah, no, I understand that completely as I try to keep my mother on her savings in her retirement years from having to go eat beanie weenies for dinner every night. It's quite a bit of a challenge. For the next question, we're going to turn to our member Thor. Thor?
Hi, Karl. Thanks for joining us.
Hi.
Do you see any risk of either a currency crisis in the U.S. dollar or a default on the treasuries? And if so, what do you see as an endgame scenario?
I think there is some risk associated with this kind of an event, but it's going to come from inaction rather than action here in the United States. We currently have a big debate going on, as I'm sure everyone's aware, about the debt ceiling, and both Democrats and Republicans are making all kinds of noise, and people are issuing threats. Geithner is running around along with others. And the reality of the situation is we have to stop doing that. S&P has kind of thrown the gauntlet down, and they're absolutely correct. They've said that not only do we have to have a plan out there now, but we have to implement it by 2013. Well, that's the first budgetary year after the 2012 elections. So we don't have time to screw around with this thing and wait until after the 2012 elections. Then we'll figure out what to do, which is what everybody likes to do. Okay, politicians are always interested in making sure they get reelected first. Then they'll talk about whatever it is that they want to talk about. S&P has made clear that that's not an acceptable path because it's what we've been doing for the last 4 or 5 years. It's just kicking the can and, let's look down the road a ways and we'll deal with it then. What I see as a real possibility is that if we have a situation develop where the international community, especially the Saudis and the Chinese, were to decide that they did not trust the ability of our government to get its act together in regards to deficit spending, and that we were just going to continue to QE until the cows came home, that the likely reaction at some point is for the Saudis to say, okay, we're not going to sell oil in dollars anymore. We're going to demand something else. And that something else could be renminbis, it could be euros, it could be anything. You could also have the Chinese turn around and start selling these things. I think there's a non-zero risk of that sort of thing occurring. What has kept people in check thus far is the fact that if you're the Chinese and you're sitting on $3 trillion in U.S. assets and you blow up the world, your $3 trillion goes up in smoke. So, there's kind of a Mexican standoff here where everybody's pointing guns at each other, but nobody dares shoot. The shorter-term horizon problem that I see coming, that I don't think we're going to avoid, is the Japanese situation. For the last 15 years or so, the Japanese have had an economic model where they bring goods and services into their country, they manufacture things, and they turn around and spit them out, and essentially take the difference as a means of financing their deficits. That's a very clever little plan, and it's worked for a long period of time. It started in the 70s, but really got cranking after the lost decade got going over in Japan, and it's how they managed to pull this off and not have it come down around their ears. They've now got a problem because they need to rebuild after this earthquake and tsunami, and that means that goods and services are going to go into Japan but not come back out. That is going to shift trade balances and trade flows. It is totally being ignored right now by everybody on the international stage. That is a huge mistake. Right now they are busy clearing away the wreckage and figuring out how many people are dead. But sometime in the next 6 months, they're going to start putting their effort towards rebuilding their country, as they must and as they should. And when they do, these trade balance flows are going to shift. And that's something that has the potential to be extraordinarily disruptive. And I see nobody paying attention to it. I think the United States has to have its act together with a concrete plan to deal with these issues before that happens, or we're likely to be into a lot of trouble.
Yeah, I certainly agree, and I think it is something that's been gravely overlooked by the majority of the market's participants. So you really are of the opinion that the Japanese Ministry of Finance and Greater Japan Inc. will sell their holdings of U.S. dollar-denominated treasuries and other overseas assets in order to finance their reconstruction as opposed to breaking out the printing presses?
I don't know that they'll necessarily sell existing assets, but I'm quite certain they won't be buying any more.
Haven't their trade balance already been impacted enough? I haven't seen numbers because the event was so recent that would give us a view with regard to the international capital flows between the United States and Japan. But I would think that would have had enough of an impact given the JIT, just-in-time delivery impacts and other aspects, that it should have significant adverse impact on the international capital flows.
Well, it's already happened to some degree. Toyota is no longer the number one car producer in the world. And that's just simply because they can't make any cars. They don't have any electricity to run their factories with. They will fix that over time. But the larger question is exactly what is the extent of the damage? And everyone's been focused on these reactors. The reactors are small potatoes in the grand scheme of things. I mean, it's terrible if you happen to, own property within, the 100 square mile boundary around the plant, obviously. But in terms of the actual damage to the economy, you got to look at this from the perspective of the fact that there's upwards of 15,000 people who died in the tsunami. And those people were killed, and all of the productive infrastructure that went along with the land mass that was inundated by salt water has been destroyed. And that's all going to have to be rebuilt. So, when we look at the disruption now, it pales compared to what's going to happen. When these capital flows start to come back into the country, it's going to be substantial. It's essentially like having, 20 Katrinas all at once. And, the United States having to rebuild, the 400 miles of seaboard as opposed to one city.
Yeah, okay. So let me try to take things back a little ways, away from Japan and back to the United States. From listening to you this evening and from reading a number of your blog posts, I get the distinct impression that you believe that there will be an asset and debt deflation here in the United States. As bad debts are written off, financial leverage is backed out of the system, and as fiscal restraint is once again restored to government budgets and finance. Why do you think that this must occur as opposed to slowly inflating away the debt problems?
Well, primarily because you can't slowly inflate away the debt problems. We have $53 trillion in the system right now in outstanding credit, which is, of course, debt to the person on the other side. The sustainable level of that in the economy, given our GDP and given historical norms, is about 50% of what is currently present, so somewhere in the $25 to $27 trillion range. The idea that we can somehow inflate away $27 trillion with a $2 trillion monetary base is laughable. If we were to actually attempt to do something like that, the dollar, which currently is trading at around 74, would trade at 7. The cost of gasoline would be $30 a gallon. A gallon of milk would be $40. Long before you got anywhere close to that, essentially everything in society would collapse. The middle class and below, the bottom two quartiles of the American economy, or if you prefer, the bottom two quintiles, if you want to be a little more precise, because the guys that are absolutely in the middle probably survive this. But the two bottom quintiles would literally be gone. And by gone, I mean starved to death and food and or rotting in the street. You've already got a huge percentage of this country that lives hand to mouth and is having a great deal of difficulty absorbing what's going on at the present time. You take a look at the jobless claims data, started to move back upwards. It's back over 400,000 again, second week in a row. And that's very clearly occurring because of what you're seeing in the commodity ramp. At some point, if you've got a minimum wage job and you live 40 miles away from it, it's not worth it for you to get in the car and go. And it's just, you don't make enough to pay for the gasoline. And it's, these kinds of squeezes happen. And we have a very large percentage of our population. Remember, the median household income in this country is only about $50,000 a year. There are an awful lot of people that simply cannot afford these kinds of hits. And not only are they getting squeezed on the commodity side, but state and local governments are actually increasing tax burdens. If your house used to be worth $400,000 and you had property taxes of, $3,000, now your house is worth $200,000, but your property taxes are still $3,000, your effective tax burden has doubled.
Yeah. It certainly is not going to be fun as we take this next leg down. You recently put up a blog post that clearly indicated that there's a linkage between the relative currency valuations and key commodities prices, especially vis-a-vis the U.S. dollar. Our next couple of questions will be coming to you from this area, currencies and commodity prices. First up, Thor, would you like to pose a question to Karl?
Sure. Are there any currencies that you believe are low risk and can serve as a safe haven for wealth preservation?
As an investment, no. As a place to speculatively or on a relatively short time frame move money around into, perhaps. One of the currencies that's been performing quite well would be to take a look at things from a standpoint of who's currently got a rising interest rate environment and therefore is showing restraint both at a fiscal level and also from the standpoint of being able to support that economically. And that would point at the Australian dollar and to a lesser extent the euro. There are problems with both of them as a buy the currency and walk away kind of transaction, though, because the Australian economy is largely dependent upon China staying in one piece, and I don't think they're going to. And, of course, the European currency, the euro, has all kinds of issues going on right now with Greece and Portugal and Ireland and everything else. As trades in and out, they're fine, and there's a great deal of money to be made there. But I believe that what you're going to see here over the next 6 to 12 months is that the federal government and the Federal Reserve are going to be forced to pull system liquidity out. And as they do so, you're going to see a ferocious rebound bounce in the dollar, and those currencies are going to get hit. So, and this is one of the things I put up in my 2011 predictions. Things are pretty much going along as I expected them to. You're late in the trade on this, and I'd be a little careful here because there's a lot of stress showing up in places. For example, China is tightening aggressively, and they just ran a set of stress tests with an anticipation of 50% real estate price declines. That's not something that is typically associated with wildly expanding speculative leverage in an economy. So I would be a little careful. Again, if you're going to trade them, that's fine. But as a place to kind of put your money and say, okay, goodbye, I think that's a mistake. One possible exception to that could be Canada. I think Canada is potentially in a little bit more of a stable situation. They have a decent set of assets in the form of petroleum and other natural resources, and the one advantage they have is that they're resource rich and people poor, and that's a good position to be in as a country.
Thank you for your perspective.
Okay, and our next question will be for a forum member, and it will be coming from Giuseppe.
Hi, Carl. Welcome. This question is from our member Green Meadow, and I'm going to read it for her. The way it goes is, commodity prices are skyrocketing. How much of this speculation are just people wanting some place to put their money that will hold value?
I think you have to be very careful with commodities as things stand right now. Of course, you can look at a chart of silver, which is the mother lode of this of the expression of this at the present time. There's a lot of people out there that believe that gold and silver as a pair are essentially monetary metals and are reflecting the safety and soundness kind of trade. My retort to that is that if in fact gold and silver are money, then why is it that they are going up in price at several multiples of the rate at which the dollar is declining in value as measured against, for example, oil or some other basket of commodities like wheat or oats or soybeans? I think the answer is a little bit more complicated than that. I think what you have there is that those monetary metals in particular are behaving as if they are leveraged instruments, even though they are not. And that's extremely dangerous because people get sucked into them. We've seen this happen before. In the early 1980s, we had, of course, the Hunt brothers took a run at silver, and gold shot the moon at the time up into the 800s and then subsequently collapsed. And everybody believed at the time that the U.S. dollar was going to go to zero and that the United States was going to suffer hyperinflation. Of course, that didn't happen. And what you had instead was gold went from 800 to 300 and change in a relatively short period of time. I look at gold more as a geopolitical instability hedge, and I think that if you were to take a look at the timeline from when the Iranians decided they were going to grab some of our people, and then when Ronald Reagan was elected, and you kind of overlaid those two events on the 1980s gold price chart, you would see something rather revealing.
Okay. She also has a follow-up on this, and the question is, how much of this rise in commodity prices are due to debased or devalued currencies, and how much are shortages?
I don't think any of it's shortages. You can take a look at the storage at Cushing, Oklahoma, which is where oil is delivered in the United States. There are people that argue that it's a matter of where the oil is versus where it needs to go. I've heard that argument. I disagree with it. Anytime that you have a large amount of a commodity in storage somewhere, someone can find a way to ship it from point A to point B if they can make that work. So I would go the other way on that. I would say that there's a large degree of speculation. There are a lot of people that are placing what amount to end of the world trades in the commodities, not just in gold and silver, but also in oil and some of the other commodities. And I think that's a terrible mistake. Oil, to some degree, by the way, is being supported by the unrest in the Middle East, and you cannot discount that. I mean, the idea, everybody says Libya is such a small producer of oil. That may be true, but Libyan oil is some of the highest quality crude available in the marketplace. So there is a outsized impact from the Libyan unrest that has not so much to do with the quantity, but to do with the quality of what they produce. There are very few sources for light sweet crude that are of equal quality to Libya's. And there are a number of refineries that are not set up to eat anything else. So, shortages are kind of a funny thing. Everyone thinks a barrel of oil is a barrel of oil, and that's not really quite true.
Thank you.
Okay. Karl, contrary to the popular perspective that is frequently espoused on mainstream media, many of our forum's members believe that economic conditions are deteriorating rather than improving, and we'd like to get your take on this. In your writings, you point to massive imbalances economically and financially. To get to these economic and financial conditions, the U.S. and global economies that they're in today required years, decades even, of errors, misestimation, poor judgment, and influences or policies at different levels. What, in your opinion, are the key drivers that got us to the conditions where we are today, and what will drive the dislocations that eventually lead to a resetting or resolution of these imbalances?
Well, I would have to agree with your members of the forum that say that the economy is getting worse and not better. I don't see how anybody can look at what's been going on over the last 3 or 4 years and find improvement in the actual underlying economic numbers. Just as one example, we have employment statistics that come out every month. In order for us to actually show positive employment as a percentage of the population, we have to post about 150,000 new jobs on a monthly basis. That's each and every month, and that's just simply from the number of people that come into the workforce. We obviously have not been doing this. So, and I graph that out every month in the participation rate. When you look at the hourly earnings, when you look at the, the amount of overtime, the average hours worked, none of these statistics are showing any meaningful increase. They're bouncing around up and down a few points here and there and have been for the last year and a half. But there's no substantial improvement. When you take a look at things like the, they talk about the savings rate, but they're not being honest about this. The savings rate is not what people put aside. They take your income and then they subtract your expenses, and the rest is savings. Well, if you're paying debt off, that counts as savings. Now, the last time I looked, you're not saving anything if you're paying a credit card. So there's a lot of distortions that are out there. These policies took 30 years to come to fruition and provide the dislocation that we had in 2007. We started with the errors on a macro level and on a policy level in the 1980s with Continental Illinois, when the FDIC chose to bail out the bondholders instead of just paying the depositors off. This is where the market got the idea that you could buy the debt of any bank, no matter what size it was, no matter how big, no matter how small, and you would not lose any money, no matter how stupid that bank's executives were. And in the case of Continental Illinois, they bought very bad loans from a failed bank in Oklahoma. It was called Penn Square, I believe, that had written a lot of paper during the time that oil prices were extremely high. Oil then collapsed in price. Those loans were worthless. They purchased them without doing any kind of diligence on them at all. They actually had at least one of their executives, I believe, came under indictment, although I don't recall if he actually went to jail. And yet the people who invested money in that bank by buying their bonds were bailed out by the FDIC, and that can be very easily argued was a violation of the charter. So we spent the next 25 years essentially allowing people to do the same sort of nonsense. You could buy layman's debt, for example, and you were not going to take any substantial haircut. You could buy Bear Stearns debt. You were not going to take any substantial haircut. We get into this situation here. You've got Goldman Sachs, you've got Morgan Stanley, you got Merrill Lynch, all these institutions. And, hey, guess what? The only one that actually went kaboom was Lehman. And out of those, there's very little in the way of actual losses that flowed through to investors. And so we built this model where institutions could do things that were demonstrably unsound, i.e. claiming they had debt covered with a credit default swap when the person they bought them from didn't have any money to pay. And when that became exposed, nobody went to jail for selling that instrument as a bogus instrument. Nobody got prosecuted for selling what amounted to insurance that they had no money behind. Okay. And in fact, 10 years prior, the financial marketplace had managed to conjure up laws that said that the states could not police these things as insurance contracts. So we've blown a huge debt bubble over the space of 30 years. The idea that we can somehow get out of this without people having to take their medicine is ludicrous. It's not going to happen. And yet that's been the entire mantra throughout this, is that, well, we can't hurt the economy. We can't hurt the recovery. We have to do this deficit spending. Well, folks, 12% of gross domestic product last calendar year was conjured out of thin air by the federal government handing money to people. So if you look at the classical economic definition of depression, it's a 10% decline in GDP from top to bottom. If you look at it from that perspective, we have been in an economic depression for the last 3 years. And there's no evidence that it's going to end anytime soon.
So what is it that's going to happen? Is it the bond market is going to call Ben Bernanke and Timothy Geithner's bluff? And are they actually going to say, no, we don't trust you. You guys are not telling the truth, and Congress will never tell the truth with respect to the unified budget, the budget. You guys are not going to be able to get this done. Is that where the dislocation is going to come from?
I think the dislocation comes from one of two places. Either we take our medicine in a controlled form, which means that Congress stands up and tells someone has to get in front of a microphone, essentially, and tell the American people, look, we know we made promises to you in the form of specifically Medicare and Medicaid and other forms of public assistance. They were lies. We do not have the money. We will find some way to help to the extent that we're able, but we do not have the money to keep the promises we made. And we're going to have to adjust both what the government provides and also what the government raises in the form of revenue. The idea that we can tax our way out of this is ludicrous. As you start to raise taxes, you get avoidance behavior, and the total amount of revenue actually can, in some cases, go down. So there is that problem. The other thing, of course, is that if you take $1 worth of taxes out of somebody's pocket, they can't spend that dollar in the economy. So you're going to have a direct hit to GDP if you attempt to fund these deficits through increased taxation. If you cut the deficit spending back, you will also have a direct hit to GDP, because as you stop the spending, you're not borrowing all this money and throwing it into the economy. So again, you have the same direct hit to GDP. The other alternative, though, if we don't do this, and this is the one that I'm concerned about, is that we continue to push the envelope to the point that something breaks. We already broke one nation. We broke Egypt. Okay? We doubled their cost of food and other necessities in the space of 18 months. This was a nation that had a per capita GDP in the couple $1,000 a year per person range. Those people are literally surviving, spending essentially all of their money on food and fuel. You turn around and you double their expenditures, their belly starts to growl. When a man's belly growls loudly enough, he riots. And that's the mechanics of what occurred here. Of course, Bernanke disclaims any blame for this, but that's nonsense. The reality is that kind of a problem can come here to America, because although we have a much higher per capita GDP, we have a lot of people that are in the lower economic strata, and more importantly, our cost of living is several times higher than it is in places like Egypt. So the minimum amount of funds that you have to have in order to be able to survive in this country is substantially higher.
Yeah. So do you think it's either going to be Congress grows a pair, stands up, and tells the American people the truth? We ride this continuing spiral to the point where there's riots because there's a last-minute cutting of Social Security, Medicare, various other entitlement programs. And you don't think that it'll be the bond vigilantes that'll ride to the market force that break things?
I think the bond vigilantes will show up, but if we get a disorderly kind of takedown of the government's credit card, we're going to have it much worse, and the risk of a zombie land kind of outcome in this country goes up substantially. Although I don't think it's going to be a particularly wonderful life kind of event, in that, Mr. Potter comes to the rescue, so to speak, right? If we have Congress grow a pair, the fact of the matter is that there are things we could do structurally with the medical care system in particular that would alleviate a lot of this trouble. It would require that Congress, show up with a set on Monday morning and tell certain industries that we know you guys have been sponging off 20% of our economy for the last 10 years, but you're going to stop, and you're going to stop one way or another. We're going to take these protections away from you, and what happens. The market will decide. Do I think the probability of that is particularly high? No, I don't. And that's one of the concerns that I have, is that our leaders, or our so-called leaders anyway, are rather spineless. And my expectation is they're going to see just how close to the edge of this cliff they can get. I believe they all know exactly what the math looks like. What I was talking about, whether you cut spending or you raise taxes, you're going to hit GDP. This is the reason that you saw the supposed $30 billion in cuts that was supposed to be $70 billion in cuts that ended up really being a couple $100 million. Okay, because they know if they actually cut back on the spending, they're going to have an immediate impact on the GDP, and we're going to recognize another quote-unquote recession. The fact of the matter is that all we're doing is recognizing reality. We haven't actually had a new recession. We never left the old one.
Okay, well, thanks very much for that. With that kind of rosy tone coming forward and what we have to look forward to, something we might think of as collapse, I think I'm going to toss this ball over to Thor and let him deal with something scary like collapse. Thor?
If there is an implosion of the economy, complete with a breakdown of society and rioting in the streets, how long could this crisis continue, and what sort of society would emerge from this?
Well, it could continue for quite a while. The concern, of course, that immediately arises from anything like that is exactly the kind of thing that happened over in Germany in the 1930s. What typically does happen to societies when they undergo that kind of collapse is you get somebody that stands up and says, I have a solution to your pain. I will stop it. But there will be some minor compromises. And we know what comes with the minor compromises. They're not very pleasant. I am not at all concerned about there are many people saying, Barack Obama is the Antichrist and he's the next Stalin or Hitler or whatever. I'm not worried about Barack Obama. I'm very concerned about the guy that is next in line after him. And I have no clue who it is, but I do not believe that person has stuck their head up above the water yet. And they won't until we actually see this kind of a dislocation take place. Much of what I've done over the last 4 years, and in fact my primary focus, is in trying to prevent that from happening, because historically speaking, countries do not go from a representative republic, which we allegedly have now for all of its flaws, to something better when they undergo this kind of an upheaval. It's usually something much worse, and that's the last thing I want.
So, Karl, do you believe this crisis is being engineered?
No. I think you have a bunch of people in Washington and elsewhere in the world who have gotten trapped by their own lunacy. Bernanke is an academic. He comes from an ivory tower world, and he believes that he has a closed system that he's working with. And that's a problem, because it's not a closed system. He has, he's got his magnum opus, his paper in which he talks about, making sure that it doesn't happen here, which of course is deflation. And he's been utterly unsuccessful in preventing the deflation of household wealth, which of course is the basis upon which our economy rests, and 70% of it is consumer spending. He hasn't managed to do a thing about that, and that's because we turned houses in the 2000s from a place to hang your hat and raise your kids into a speculative financial instrument. And unfortunately for him, his dream and desire is to make everything go back the way it was, and that can't be done. So I think what you have here is that he's gotten himself backed into a corner, and there's 3 words you will never hear come out of a politician's mouth in Washington, no matter who they are, no matter what party they're with, and that's, I screwed up. And as a result, you've always got people trying to build on their last mistake instead of saying, you know what, we blew it, we're going to throw this out, and we're going to do it differently.
Okay, thank you for that, Karl. We're going to toss our next question over to Giuseppe.
Okay, Karl, my following questions have an underlying premise that our financial system has already collapsed. as has our system of government, including a currency that is just not accepted anymore. Okay. I live in the suburbs of New York on Long Island, a heavily populated area, but part of the money center of the world. My situation, other than that, does not differ much more than other folks living in big cities. If we have no other place to go, how can I and others prepare for such an outcome?
Get out. figure out how to make that not true. I used to live in Chicago. I spent 13 years in that town. I still call it my sentence. And I ran an internet company there during the 1990s. If you are at all aware and you're walking, from the corner grocer with a bag of groceries back to your apartment, and you look up and you see all these windows and all these buildings, and you think, gee, how many barrels could be sticking out those windows at me if somebody really wanted this bag of food? The answer is more of them than you can defend against. Okay, so we have a society that is largely dependent upon the fact that nobody wants that bag of food all that badly, and they're not willing to murder to get it. Right. If that veneer is ever lost, the cities will go feral in about an hour. And there is no defense within those enclaves against that event. They're just, as a practical matter, there isn't anything you can do other than don't be there. So I would say to people, figure out what you're going to do if that sort of horrific consequence comes to pass ahead of time. And that may involve, for people who literally can't leave, that may involve some kind of community organization between yourselves and, 100 of your new best friends, because that sort of thing may definitely be necessary. I don't like the general vision that we have if, for example, you were to lose fuel deliveries into the major metropolitan areas. The consequence of something like that would be unthinkable, and it would happen almost immediately. So what I tell people, I get asked this question all the time. Okay, this is one of the more popular ones when I do interviews, and what I tell people is this is why I put so much effort into trying to make sure it doesn't happen, because I don't see any happy face that you can put on something like this and say, well, if I do X, Y, and Z, it'll be okay. That's fantasy land stuff. It will not be okay. So what you have to do is figure out how to make that not occur.
Right. Other than flea markets or farmers markets, can you give us your ideas on how a community can organize a barter system market, makes some type of simple advertising ideas, or maybe best locations where these would be more effective?
In a large city, there really isn't anywhere you can go with this, because there are very limited options that you have available to you for example, for growing food. There are some things you can do with window boxes and things like this. Okay, so you're not totally locked out. But the idea that you're going to be able to feed yourself with a couple of window boxes hanging off your 40th floor apartment building, by the way, with windows that don't open, is again a fantasy. Okay, so I think that if you're in a suburban or a rural area, it's a little different situation. There, the farmers markets and the flea markets and things like this do make some sense. What I would say to people is figure out how you would simplify your life. That if all of the luxuries that you enjoy today, figure out what is truly a luxury, what is not, then look at what do I have to do to get through a short-term disruption, say a couple of weeks to a couple of months. If we manage to get that far and things stabilize, we'll be all right. There isn't a lot that you can do in a major urban environment if we're talking about a disruption that goes on beyond much more than 30 days. There just isn't anything you can do realistically other than get out of there. And there may not be a good way to do that. So, bug in works up to a point. But, you look at what happened over in Egypt. That went on for a relatively short period of time. Consider what would have happened if the entire country had been cut off from supplies, not just the area around the square. It would have been an absolute disaster, and it would have degenerated into rioting almost immediately as opposed to demonstrations.
Thank you.
And to find out how we're going to get there from here, we're going to turn to Mulder, who is going to ask Karl that horrible question.
Okay, Karl, could you lay out your most likely scenario as to how you think our financial and economic system might collapse if the government can't get its act together?
I think the most likely scenario looks an awful lot like what happened over in Greece at the initial levels. That is, we lose our AAA credit rating, we lose the trust, if you will, of the international community. The dollar initially would see a large sell-off, and the price of oil and other commodities would skyrocket. If you think that oil is expensive now, you haven't seen anything. The problem with that is that the classical wage price spiral kind of hyperinflation scenario can't play out in a globalized world. And so what you would have instead of that sort of a feedback mechanism is the destruction of the lower and lower middle class in the country. At some point, they would reach for the weapons and riot. They probably don't have guns, but I bet they have gasoline in bottles. And from there, things get very bad, because when the government is forced to cut off the deficit spending, then all of those handouts, of course, go away. This, in turn, causes a feedback mechanism within the economy. If you take the deficit spending away, that's about 12% of GDP. But if Barack Obama doesn't buy his 2 new limousines this year, the guys that are going to make those limousines don't have jobs, and so the actual impact is much larger than the 12% first appears. In addition to that, as the employment base is further damaged, you have a larger and larger collapse in the tax base. The government is likely to respond to this by attempting to increase taxes into this environment, because they have no choice. Okay, what they did originally was attempt to cut taxes, but that's only because they were able to continue to borrow. If that option is foreclosed, then they will attempt to raise taxes. They'll do it first on the very wealthy. That is not going to go anywhere, because the very wealthy can get in their Learjets and leave the country, and they will. And the next thing that comes is punitive taxation on capital gains and things like this. So for people that think they're going to hide, for example, in gold or silver, have a nice day. Whatever currency system we end up with has a 90% capital gains tax on your gold. And oh, by the way, if you can't prove what you purchased it for, the basis is 0. So just hand over 9 of every 10 units of currency that you transmuted into, which effectively means you did not protect your wealth. So again, the risk of this degenerating very quickly from an economic crisis into a political crisis, where there is a loss of confidence in the government, and from there some very ugly and scary things, is quite real. I hope that doesn't come to pass. The closer we get to this cliff and the longer we keep playing this game with deficits, though, the higher the probability goes, because the damage that is done by into the economy by doing this is compounded. Back in 2000, my estimation was that we had to take about a 10% contraction in total GDP in order to clear the system, along with the excess credit. In 2007, that number, just on a back-of-the-envelope calculation basis, was about 20%. Today, it's about 30%, and at some point it becomes impossible to sustain, and you get a self-sustaining spiral on the way down, and essentially gross domestic product goes, for all intents and purposes, 0, because the only thing that you have is the farmer that can grow food for his own consumption and barter or trade off whatever he has in excess, which, by the way, is not the big corporate farm, which doesn't have any fuel to operate on in order to plant their crops. We're talking about the guy that has 40 acres out the back door. That's going to become a problem too.
Okay, thank you. And in the very unlikely event that the government can actually get its act together and start to do the right thing, however you may define this, could you lay out the best case scenario as to how the government might be able to gracefully deflate the current bubbles?
Yeah, I think what you do is the first thing you do is you cut off the deficit spending. What I have put forward is a total cessation of deficits on an instantaneous basis would essentially be like setting off a hydrogen bomb in the middle of New York City in terms of impact. So That's clearly not a rational thing to do. But what you could do is you could say, we're going to take $500 billion out of the deficit this year, we're going to take $500 billion out next year, and we're going to take whatever is left to get us to a $100 billion primary surplus in 2013. The market would treat that as being very credible, provided it was real and it couldn't be fudged. The result of that would be a very sharp move upward in the dollar. It would force a cessation of a lot of the deficit spending that has gone on an immediate basis. So at the same time, you need to do two things. One is that you have to pull back from the foreign protection that we're providing in places that are not linked to our supply of energy. And that means a major cut in the Department of Defense. But you cannot, as many people want to say, there's so many people that want to just pull out of Iraq, Afghanistan, basically walk away from everything related to energy force projection. We cannot do that, folks. We are today paying $200 a barrel for imported oil when you take a look at what we are actually spending in terms of DOD spend per barrel of imported petroleum. The price is not $100 billion or $100 a barrel, it's $200 a barrel. We need to redirect that into U.S. consumption and U.S. production capacity. We can't stick straws in the ground. We need a better plan. I've put one out there that involves using thorium as an energy source and coal as the feedstock. It is viable. It works. We know how to do it. It will require funds, but we can shift Defense Department money into that and fund the ramp that way. At the same time, we have to take the medical system. We have to throw both the physicians' networks and the drug and device makers to the wolves. Today, we have a system that relies on a law called EMTALA that was passed in the 1980s. It says that if Juanita, the illegal immigrant, comes across the border, 7 months pregnant, been doing drugs the entire time, walks into a hospital and poops out a baby that it then ends up in the NICU, that the American taxpayer has to foot the bill not only for the delivery but also for the $1 million worth of care that child requires. We cannot continue to do this. We also cannot continue to live in a society where we have people that are of elderly age that have made no provisions for their own care that then have a quadruple bypass and 2 new artificial hips. I understand that people say, well, you can't throw grandma down the stairs, and I get that at a social level and at a level of compassion. But the fact of the matter is that we can write checks with our medical technology that we cannot cash with our pocketbook. And we have to bring those two things into alignment. What that's going to mean in the short and intermediate term is that people are going to have to grow up and deal with their mortality. And it's a nasty subject to broach, but we have to have an adult discussion about this as Americans. We haven't been willing to do it on either side of the political aisle, and it has to happen now. We can get there. We will have to absorb a 20 to 25% contraction in GDP over the short term. If we do that, I would recommend immediately sending every illegal alien home, regardless of what we have to do to accomplish this, because we should allow Americans to have those jobs before we give them to other people. And for those who say that Americans won't do them, I'll point it out in Arizona where they had a Chinese restaurant that had hired a bunch of illegal Mexicans. They busted them, they sent them home, and voila, all these people were willing to cook food for $7 and $8 an hour because it was better than zero, okay, which was the alternative that they had. So we do have people in this country that can fill those jobs. We need to reform the tax system. I happen to be an advocate of the fair tax, but it's not the only path. And like I said, we need to fix the medical system. We do those three things, and you trash all these big banks. You force them to eat their cooking. You deflate the debt. It's going to detonate the 5 biggest financial institutions in the United States will all go bankrupt. The only possible exception is J.P. Morgan. I've done the math on this. I'm convinced they will all go under. It's okay. No depositor will lose any money. The FDIC will not get tapped. The bondholders will get destroyed. That's the way life goes. We have to take this pain is coming. Jesus did his thing on, if you're a Christian, over, well, in fact, last night, right? And they nailed him up on a tree, and he said, I got to do this. From taking this hit and from doing the right thing comes renewal. We fix the tax system, we fix the medical system, we get the excess debt out of the system. the leverage goes away, and we have an economy that's sustainable. But we are going to end up with an adjustment downward in American standards of living. There's no way around this.
Okay, thank you. Now for a somewhat darker question. Could you lay out the worst case scenario that you would envision, and what would be the events that would be likely to foreshadow it?
Well, the worst case scenario is that we break something overseas and we get this adjustment that I've described, but we don't do it on our terms. We don't have the discussion with the American public. It just comes and hits us in the face. The most likely place this originates is either over in China or, God forbid, we start a war over in the Middle East through some mistake. The possibility that the Saudis get involved in some sort of massive civil unrest and the oil gets cut off would certainly be sufficient to trigger something like that. The consequence of that sort of a event would be a likely doubling of oil prices in the space of hours. And the consequence that flows from there is a almost immediate shutdown of the interstate transportation system that provides the food, fuel, and everything else. We would have to direct the military in some form or fashion to keeping those routes running. We have a fair degree of fuel storage and things like that in the short term, but the disruption that would come from doing this in a disorderly fashion would be extreme. The idea that we could just cut off all of the government spending without having a conversation about it first, and without politicians being willing to stand up and be honest with the American people, I'm afraid the shotguns would come out. And, the problem with angry mobs is they tend not to look towards the people that actually caused the harm. They just do crazy, nutty things. You look at what happened out in L.A. when with the Rodney King situation. These people have this ability to become animals, and I am not looking forward to that sort of a circumstance at all. Once it gets going, it's going to be very hard to stop and control.
Okay, thank you very much.
Karl, many forum members are of the opinion that most of the financial problems stem from a category of institution we classify as corrupt bastions. Among these are the Fed and the banksters. For our first question in this topic area, we'd like to turn to Giuseppe. Giuseppe?
Okay, Karl. As you have said prior in some of the YouTube shows that I've seen, the shenanigans of the Federal Reserve, the Treasury, and all their Wall Street friends using our money to cover their losses. If this ever comes to be understood by the public in general, then I would think game over. The credibility of the Federal Reserve would be completely shattered. The printing of money will stop. Debt will not be issued against our tax dollars. I then see a system grinding to a halt. If you agree with the simple scenario, what would you advise be going forward?
Well, I think there's a very real possibility that happens. I don't understand how anybody takes Ben Bernanke and the Fed seriously at this point, to tell you the truth. I mean, the man has literally been wrong about essentially everything he's ever said, but yet people continue to listen to him. At some point, this will change. I would say that the most important thing to have in that sort of circumstance would be a reasonably secure place to live, B, the necessary tools of whatever trade you are good at to be able to reestablish commerce in the way that it ought to be done. In other words, you may go and push paper today, but if you know how to fix people's tractors, that would be a very useful skill in a time like that. And then have, not have claims outstanding by other people. So my general advice has been, number one, get out of debt if it is at all possible to do so. Certainly get out of any kind of debt that can be called or cranked against you in terms of interest rate and terms, i.e. credit cards and things like this. And secondly, look at what it is you would need to have to establish yourself as having economic value in the world, to the world in general. And there may be, things that you can do today to do that. I think there will be a great opportunity during this process, if we have that kind of a thing becomes underway, where you'll be able to, let's say that you're a machinist, you know how to run a lathe and a CNC machine. You'll be able to pick these things up at a tiny fraction of what you would pay for them today. This kind of a thing happened during the Depression, and it is the way that you find long-term wealth. It won't make you rich quickly, but it will put food on your table, and ultimately it will be the way that you're able to prosper. But you need to be able to take advantage of those opportunities when they arise, and you don't know when they're going to happen. My internet company, to a large extent, came out of this. We had a nasty little short recession in the mid-1990s, and it was an opportunity for me to pick up a lease on real estate that we could have never afforded had we had to pay anything close to retail rates for. So these kinds of things come up from time to time.
Okay. Well, other than skills or the skill sets that people would have, do you think maybe a different type of form of currency would be viable in this type of event?
Not particularly, because governments, when they undergo this kind of situation, have a habit of stealing anything they can get their hands on. And if you think you've avoided it, you're probably wrong. You can always attempt to diversify into other currencies. The problem is the government can always come after you with capital controls and capital gains taxes. And I hear people say, well, I'll just barter and I'll deal in the black market. And my answer to that is that if you're comfortable with committing acts that the government may define as felonies, then that's certainly fine. But then again, I can say the same sort of thing to somebody who says, well, I'll just stick up convenience stores. At the end of the day, if you go to jail, none of this does any good, right? So right. I look at how do I avoid that scenario, and I think the real question is, how do you get to where what you have to survive, and how you can have what you can do in terms of your skill set and your ability to produce at a form that makes you valuable to the people around you, because that ultimately is what will get you through it in the end. You can play games in the short term, but over the intermediate and longer term, none of that stuff's going to work.
Carl, thank you.
Okay, so if we're going to be stuck with currencies, as opposed to devolving clearly into a barter variety of economy at the back end, what should the role of the Federal Reserve or a monetary authority be, if anything, since politicians cannot be trusted with monetary policy given the failures of both major parties to operate with fiscal sanity, and the Fed is clearly a political and secretive animal as well? How can an institution be set up to be responsive and responsible to the people and not to the financial powers on Wall Street, or, in the case of the politicians in D.C., since they're so heavily influenced by the K Street lobbyists?
I would like to start in response to that by pointing out that the Federal Reserve Act, as it is actually written, has very little wrong with it. And that's probably going to shock some of your listeners. If you actually read the Federal Reserve Act, it calls for stable prices. Well, stable means unchanging, right? So where does this 2% inflation thing come from? Well, it comes from the same place that we have the FDIC that's supposed to close banks before they go under and cost the insurance fund money. And that is the fact that all of these wonderful laws and regulations don't have an or else in it. There is one if you decide to go rob a bank and stick a gun in a teller's nose. There's an or else. It says don't do that, or else you go to jail for 20 years. There is this curiously missing clause in all of these federal regulations and laws that govern the government and arms of it itself. And that is, nobody ever goes to jail because there's nothing in the law that says they have to when they break them. So without fixing that, we can't solve this problem. And the last thing I want is Barney Frank having control over monetary policy for the United States. We'd have hyperinflation in about 15 minutes. So I don't like the Federal Reserve in the way that it's operating, but the Federal Reserve is operating outside the boundaries of what it is allowed to do, and yet Congress is the body that is supposed to enforce this. The reality of the situation is that the American public needs to grow up. We need to look at the body of law that supposedly governs us in the Constitution. We need to look at the laws that enable everything beyond the Constitution. And we need to say, you know what? We cannot have a law that is not actually a law, that's just a suggestion. If you're not going to actually have a penalty associated with it, then throw it out. Get rid of it. Get rid of this facade that there is some supposed check and balance on these people's behavior. And then, if look at what you have left and say, is this acceptable? And I think that the public would say, no, it's not, and demand that we actually have laws that have teeth in them. But as it stands right now, I don't know what we do with this, to tell you the truth. There's one of the things that's gotten me so upset with people like Ron Paul is that he supposedly is a maverick. He's very anti-Federal Reserve, and yet when he has the opportunity to nail these people, especially Bernanke, with the fact that the law itself, the actual black letter of the law, prohibits what he's done, and what all of the Fed chairmen have done since 1913, he refuses to do it.
And it's a real shame that those people who we've elected to be our representatives haven't stepped up in that way. Let me turn things kind of into a different area. Karl, my impressions of your views are that you perceive that there is too much regulation holding back innovative entrepreneurs and businesses. And yet you also applaud, or appear to applaud, efforts to reinstate the regulatory elements of Glass-Steagall, the Depression-era law that separated commercial banking from investment banking from insurance, and to repeal elements of Gramm-Leach-Bliley that sanctified the current financial mega-firms that dominate Wall Street. If this interpretation is correct, should there be a double standard regarding regulation in the financial sphere versus within the real economy? Deregulation in some areas of the real economy, be it pharmaceuticals, medical devices, foodstuffs, home products, electronics and electrical equipment and devices, to name a few, in a caveat emptor, free market economy, can be very harmful, just as bankers and financiers run wild are. In your opinion, should there be a caveat emptor, let the buyer beware end, and no oversight or protection for the less knowledgeable through regulation? Where should one point end? Where should the other begin?
Well, in the financial realm, there's a couple of distinctions that I draw specifically with regards to banking and lending in particular. I have advocated for a long time a standard in the banking regulatory environment called $1 of capital. That goes substantially further than Glass-Steagall. And what $1 capital basically says is that we have to stop banks and other financial institutions from essentially trading on the credit of the sovereign, that is, in this case, the United States. And this is the reason that I don't believe that we can have a so-called free market with the current system in the financial realm, because a bank does not actually trade on its own credit. A bank, through the ability to make loans that are not backed by anything, is essentially trading on the credit of the government. Well, but the problem, of course, is that the bank is not accountable to the government when it screws up, as we've seen. Okay, so you have a situation where an institution can issue loans without having anything behind it whatsoever, and by doing so effectively expand the monetary base, that is, create inflation from a monetary perspective. And this is where the people that have the gold standard ideas get it wrong, because throughout history we have seen that even when you have a hard monetary standard, if financial institutions are able to do this, you get the same inflationary boom cycles followed by busts that you get if you're on fiat currency. It makes absolutely no difference as long as I can issue credit without having to actually back it up with something. So there's nothing wrong with lending your capital out. There are other people who want to get rid of lending at interest, for example. And that's communistic or fascistic. If I have capital, I have a right to let you use it in exchange for a fee that you and I privately negotiate. But when you have institutions that trade on someone else's credit, what you're essentially doing is giving them the ability to obligate other people. And that's where the problem has come from within the financial realm. That's why this has to stop. I don't think there's any kind of double standard here at all, really. My advocacy is that the ability of people to exploit others through the through this mechanism needs to end, and that is what $1 of capital would do.
Okay, thank you very much. We're going to turn now to our forum member, Mizar, who has some additional questions for you.
Good evening, Karl. This is a great conversation so far. I'm sure it's going to get better. My first question is from forum member G-Dog, who couldn't give it up himself. The question is, why hasn't there been prosecution of any bankers, even though there is overwhelming evidence against them?
Well, you'd be prosecuting yourself. Go back to what I just said, in that essentially the banks are not trading on their own credit, they're trading on the credit of the federal government. So to prosecute the bankers would be to prosecute yourself. Well, that's not going to happen. And essentially the whole mechanism here is that the banks have inundated the federal government with their own stooges. I mean, take a look at Tim Geithner, for example, comes from the New York Fed, becomes a Treasury Secretary. Henry Paulson before him, where was he from? Oh, Goldman Sachs. Gee, there isn't any kind of inside trading going on there, is there? So, and then you have Mary Shapiro. She comes from FINRA. It's kind of like saying we have the police department, and we're going to bust the police officers for speeding. And we expect the police department to write tickets against their own officers who are speeding in their marked police cars. Well, that's not going to happen. So when you have this capacity to essentially bind the financial system and the government together through this kind of perverse inside dealing, it's an incestuous relationship, you cannot be surprised when the federal government refuses to charge the people who have committed crimes because they'd be charging themselves. It's not realistic. We have to change the paradigm.
Thanks for your answer, Karl. The next question from G-Dog is, why do we borrow money from the Federal Reserve when we could just be printing it, which is exactly what we were doing in the first place?
The short form of that answer is that, in theory, borrowing the funds provides a check and balance on out-of-control, runaway federal deficits. We're seeing how well that works, right, in practice. The problem with simply printing the money is that if Congress was to do that, the likely impact in the world market would be an immediate revulsion on the part of using dollars as a reserve currency and as a trade clearing mechanism. We have some history with that. President Lincoln printed greenbacks to finance the Civil War. They were devalued by something like 60% over the course of 18 months and ultimately became essentially worthless. The problem with giving the monetary authority to Congress like that is that historically is what's likely to happen. So the system we have now has its flaws, but even if we were to get rid of those flaws and not do things that way, and if we could regulate the emission of currency such that we did not have an inflationary problem caused by it, the concern that I would have is that it doesn't change the fact that you still need recessions to clear out excess debt, because it is not just the federal government that borrows, and in fact the federal government's borrowing as a percentage of the whole is relatively small. So yes, it's a large amount of money, but when you look at the total pile out there of $53 trillion, $14 trillion is a large number, but it's not anywhere near 53.
Good, thanks, Karl. Those are informative answers. I'll put it over to the next person.
Okay, Karl, it's McLaren back again. Would you agree that there is a plutocratic financial oligarchy running or heavily influencing not just the United States, but much of the G20 or maybe G7 limited world? If so, are they controlling events and outcomes as vested interests tend to take and keep ever larger slices of the pie? Is there an appropriate balance between prosperity for the majority versus the minority? And how can it best be achieved if the minority are institutionally advantaged to keep the playing field tipped in their favor? How can crony capitalism be stopped?
Well, there's certainly a plutocratic financial oligarchy, but I would call it kleptocratic instead of plutocratic, because they stick their fingers in every pie they can find and they pull all the plums and the cherries out and leave you with the crust. The biggest problem you have with correcting this is again, it goes back to the ability of these institutions to essentially stuff the regulatory and government apparatus with their own people, and then trade on the credit of the government that they have captured. Bill Black has talked a lot about this. It's essentially regulatory capture and a rotating theft mechanism, if you will. And unfortunately, the solution to it is found in the people, because, we constantly hear you got to vote Democrat or you got to vote Republican. But I have been casting ballots every year since I turned 18, and I've yet to go into the voting booth and find only 2 names on the ballot for major offices. We just refuse to believe that anybody else can win, and therefore anybody else is worthy of our vote. And yet, the fact of the matter is that we are, to a large degree, our own worst enemies. We had Barack Obama tell us that he was going to bring us change, and yet right during his inauguration, some woman pops up on television, and it's been immortalized in a YouTube clip now. It says, Obama's going to pay my gas and mortgage. Well, hello, the way you pay your gas and mortgage is by getting off your butt and going to work. Who is really at fault here if we all appeal to the nanny state and then basically demand that they steal from others and hand out scraps? We get the system we deserve, and we get the system we vote for. I don't have a lot of sympathy for the plight of the American underclass when the American underclass continues to put itself in this position. I mean, just as one example, you take a look at the